Hey guys, it's Sasha. Are house prices about to collapse, and will this trigger a broader financial crash taking the economy down with it? Are we about to lose a whole lot of money? Are your investments at risk? Well, data coming out over the last few days suggests that the housing market is deteriorating rapidly and house prices are starting a very sharp fall. Let's go through this data and try to understand what's happening. How bad could this house price crash get? What are the triggers, and what does all this mean for you? In the last few days, Zillow have released their updated home value index data for September, and house prices in the US grew by 0.1% on a seasonally adjusted basis in September compared to August. The index sat at $357,810 in September, which was only $356 more than in August. And the reason this is significant is that this is the smallest increase in this index in the 8 years that the data has been collected. In August, prices increased by just over $1,000. In July, they increased by $2,400, and in June, they increased by $4,400. So the trend is pointing very strongly at October being the first month since the financial crash when house prices may fall month on month. And the problem gets a lot worse when you dig a bit deeper. By the way, if you are concerned about the state of the housing market, the state of inflation, the energy crisis, or the impact of a potential recession on the stock market, you could instead choose to park your money in art with MASTERWORKS, who are the sponsors of today's video. Prices of art go up and down just like stocks or anything else, but according to the Art Price 100 index, the price of leading art has outpaced the S&P 500 by more than 100% in the last 22 years. And you can see how the price of art did while the stock market was getting destroyed in the dot-com crash and in the financial crisis. Although past performance is of course no indicator of what will happen in the future. MASTERWORKS works by buying famous paintings and securitizes each one so that you can go and invest by buying shares. MASTERWORKS will then store the painting, and at some point in the future, they will sell it, hopefully for a profit. Investing in art has its own risks. Your money might be tied up for some time, it's not the same as buying a stock, but the artworks that MASTERWORKS sold so far do show some very interesting returns, and you get to invest in a real painting by somebody like Pablo Picasso rather than a cringe crypto token. The CEO of MASTERWORKS, Scott Lynn, said art as an asset class is not a GameStop or an NFT. At the end of the day, returns are fairly predictable, which sums it up nicely. If you are curious, use my link in the description to skip the waitlist and get priority access to the platform. So, house prices themselves are not the biggest problem for house prices. They're not even the second biggest problem, because the second biggest problem is the volume of sales on the market. In August, the volume of sales in the US fell slightly compared to July and has continued the downward trend that we've been seeing every month since January. This decline means that house sales are now at their lowest level since the COVID crash in March and April 2020, and sales are running at about 12% below pre-COVID levels. And as the number of sales continues to drop, two things are happening. First, the average house sale data becomes distorted. House sales are dropping because of macroeconomic factors. We have 2 consecutive quarters of GDP falling, high inflation, and that means that people are facing a cost of living crisis. But this crisis, the potential risks around jobs, the ability to get a mortgage, affect people on lower incomes considerably more than those on higher incomes. So as house prices dip, the weighting shifts disproportionately in the house price data away from the cheapest houses towards more expensive houses, and this creates an artificial balancing effect which makes prices look a bit better than they are. Higher priced homes become a larger proportion of the overall total number of homes being sold, and this masks how much the house prices are actually dropping. Here is how this effect works. Imagine you have 20 house sales back in August. 5 of the houses cost $800,000 and 15 of the houses cost $200,000. The average price of the houses sold is $350,000. Then imagine all house prices, the expensive ones and the cheap ones, fall by 10%. So expensive houses now cost $720,000 and the cheap houses cost $180,000. But sales also drop. Instead of 15 cheap house sales, we now have 9. So we have a 40% drop in the number of cheap houses being sold, but expensive houses only drop by 20%, from 5 down to 4. Now we have 4 sales at $720,000 and another 9 at $180,000. And the average sold house price is now $346. So all house prices fell by 10%, but because the distribution between the expensive houses and the cheap houses has shifted, the average sale price has hardly moved. And in fact, we can see that house prices have already started falling despite the data not quite showing it as clearly yet. The Zillow index that most media services will quote is the seasonally adjusted version. If you remove the seasonal adjustment that they make and just look at the prices as they are, house prices peaked in June and have been dropping for the last 3 months since. But the problem is that there is a very real risk that house prices can go into freefall from here because of interest rates and mortgage risk assessments. Interest rates is the topic that is now getting a lot of attention in the media, and as interest rates rise, so do mortgage rates. The typical 15 and 30-year mortgage rates in the US were 2 and 3% back in January, but these rates have now gone up to between 6 and 7%. This is a huge increase. An average $350,000 30-year mortgage on a 3% interest will cost you $1,475 a month in mortgage repayments. Less than $500 of that is repaying the mortgage. About $1,000 is interest. But crank that interest rate up to 7%, which is what we have today, and suddenly the mortgage repayments go up to $2,328, about $850 more every month. And for the average household, that is an increase that is going to be extremely difficult to stomach. In 2 weeks' time, the Fed is meeting again to discuss increasing rates and is likely to increase rates another 75 basis points. If mortgage rates follow, like they have been doing so far, mortgage repayments will go to over $2,500, another $180 a month. The median household income in the US is $67,500, so after you take out tax, the average mortgage repayment will become 60% of the average take-home pay for an average family, and that is bonkers territory. The ability of people to meet the financial requirements of getting a new mortgage is hitting the floor. Buying a house went from somewhat affordable at the beginning of the year to nigh on impossible in just 8 months. The Financial Times reports data based on Zillow that says house prices in big cities like New York, San Francisco, and Los Angeles have been getting cut very sharply between June and August. So as demand for houses is collapsing, so are the asking prices. While last year, the bidding war for houses meant that people competed on how much over the asking price you were going to pay, this year people are negotiating discounts of the asking price instead. Discounts of the asking price that is itself falling. Inflation has been sitting relatively flat at just over 8% over the last few months. And this has meant that a lot of prominent commentators and business people have declared inflation to be over. It has peaked now and is on the way down, the trending economic analysis favored by Cathie Wood, Elon Musk, and others says. The evidence being cited is a fall in commodity prices, which means that prices of goods are also expected to fall as a result, and high inflation doing its part in naturally destroying demand as people scale back on non-essential spending. But if you look through the inflation data in a bit more detail, you notice that non-essential spending is not really the problem. Things like food are still going up at 13% year on year in the latest report for September. And in the last few months, energy costs have been falling because the price of oil and natural gas fell. So in October so far, oil and gas prices are continuing to fall, and this probably means that energy costs will continue masking the overall inflation rate in everything else, because most other key components in the CPI index are going up very fast, and it is only the big declines in energy costs month on month that are keeping the inflation from looking considerably more ugly. Jerome Powell has been increasingly indicating that the Fed is seeing it this way as well, and this means that the Fed is going to continue to increase rates until inflation starts dropping, and only then look at reversing the policy. But as winter sets in Europe, Russia's war in Ukraine may keep gas energy commodities at elevated levels, and if the energy part of the index stops dropping sharply every month, we may see inflation start to increase in big increments again, which will prompt the Fed to go even further with their rate hikes. If inflation goes to 9 or 10%, it is possible that we will see rates hitting 7 or 8% next year. And there is a growing debate as to whether a sustained higher rate of inflation over a longer period of time, like 10, 15, or 20 years, is a better solution out of the mindless money printing during COVID than a Paul Volcker-style hammer approach that is likely to destroy the economy by setting rates to 15 or 20%. In any case, mortgage rates could well hit around 10% next year. It's possible. And at 10%, the monthly mortgage payment on that same $350,000 house becomes $3,071. And if things are looking bad already, that will destroy whatever demand for houses still exists after the recent rate hikes. But not only will people fail affordability checks on mortgages because they simply can't meet the monthly mortgage repayments, if Jerome Powell does follow through on increasing rates all the way to inflation dropping down to 2%, as they've been saying, we could well see a very sudden contraction in the economy. Businesses will be collapsing right, left, and center because their debt burdens are unsustainable, and a destruction of the demand for goods and services will take hold. People will just stop buying stuff. Jobs will start disappearing, and incomes, especially real incomes after inflation, will come under increased pressure. So suddenly the risk of buyers not being able to meet their mortgage payments will increase significantly. And if you're a mortgage lender, this is a problem. And that will make the problem of being able to get a mortgage even worse, because mortgages will now have to bake in that extra level of risk. So in that scenario, which is becoming more probable by the day, house prices are likely to continue to tumble. And given the relatively unique situation we're in, it is very hard to predict how far they will fall. Even a 50% drop in house prices still means that monthly repayments will be above where they were back in January if mortgage rates go over 10%. And this could make selling your house pretty difficult. Having said that, house prices did explode in the last 2 years since COVID arrived. From June 2020, house prices have grown at the highest rates we have seen in the last 20 years. And so you could argue that even a significant correction in house prices is not so much of a fall as a reversion to the mean growth trend over the long term. If you are not on a 30-year fixed mortgage like many people in the United States, if you live in the UK, for example, you might want to plan ahead for how you might tackle a massive increase in the cost of your mortgage when it is time to refinance, because that time may come and getting a replacement might be more difficult than you thought. If you are planning to move, remember that getting a mortgage might not be as quick and easy as a box-ticking exercise as it has been for many people over the last 10 years. And if you are investing in the stock market, beware. A sharp drop in property prices could set off all kinds of expected and unexpected events similar to what we saw in the financial crash. Many pension funds, large portfolio managers have very significant exposures to the property market. And we saw what happened a few days ago in the UK when a slight uptick in bond yields almost collapsed several large pension funds. So who knows what will happen if property dumps 20 or 30% in a short period of time. We are sailing in uncharted waters with very little in the way of directly applicable past examples. It's impossible to tell which way this storm is going to go, but we probably do know that it's going to be fairly choppy. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, and I'll see you guys later.